result, really driven by some large allocations that we have to credit, to the credit asset class, where we see the opportunity to earn good returns. 2017 was a good year for any investor in the equity markets. The Toronto Stock Exchange rose by just over 9% last year. OMERS was able to deliver a return of over 14%, strong return. The strategy is simple: buy the best quality equities that we can find, and you can see the good results. Our private asset classes, private equity, infrastructure, real estate, all did very well. Those asset classes have performed very well for OMERS over at least a 5-year time horizon. Consistent, strong returns. We had some very high-profile sales of assets this year in our private equity group, the Civica sale, the Husky sale. You may have read about those. In our infrastructure team, the sale of our railroad in the UK, and also in the real estate team, the sale of a major London property. Those led to the strong returns that we see here. Now, these returns are net returns, which means they're stated after all expenses. We pay pensions with net returns, and therefore it's important for us to focus on our costs. Costs of running OMERS last year, 55 basis points was the management expense ratio, a little lower than the 61 basis points that we had in the prior year. We've set ourselves a long-term target. We want that to be around 50 basis points, and we believe that we can drive towards that target over time. As Michael said earlier, we'd like to introduce some third-party fees into our structure, and we think that will really help us. On the pension side of the business, it costs us about $195 per member to run the OMERS pension plan. That compares very favorably with our peer average, and our board spends a lot of time looking at our costs every year to ensure that they're satisfied that we're spending our members' money appropriately. When I think about earnings of our pension plan, I also think about the quality of the earnings. And as you can see this year, about half of the income of the pension plan came out of public investments, and about half came out of our private investments. And I want to spend a little bit of time analyzing that with you to show you where OMERS is earning its money. Our public investments, we seek to have about a third of our investment income coming in the form of capital, and about 2/3 coming in the form of cash, in the form of interests and dividends on the stocks and bonds that we own. That ratio was inverted last year because last year was such a strong year for capital return. On the private side of the business, we have a very large allocation to private investments. Very often when I've come before this meeting in the past, you've asked me questions about the valuation of those private investments. When you have public assets, you can look on a computer screen, or you can look in the newspaper and you can see high transparency around those valuations. On private side, we have to value those assets, and so we take that very seriously at OMERS. 82% of our assets by value were reviewed by external parties for 2017, so we have a good level of comfort around valuation. But when I look at the components of the return, and you can see it there, of the $5 billion of investment income that we earn in private assets, $3.5 billion was realized. It came in the form of my favorite asset class, cash. And when we earn cash and we earn investment income, our fund grows. $95 billion strong. That includes $817 million of additional voluntary contributions, which is an avenue for our members to save even more to their retirement. 18,500 members of the OMERS pension plan also invest in AVCs. $20 million was invested in the income option. I had a question coming in: what happens when you reach retirement? You can roll that into a retirement product, very much like a RIF product. And when the plan is growing, and when the plan is producing as much cash as the plan has created, it means that our investment teams have to put money to work. In 2017 was a very busy year. 13 real estate acquisitions. We committed to 9 new developments. We made 2 very significant investments in infrastructure, including our first in South America. We had 2 large private equity acquisitions and a host of public equity, public credit, and private credit transactions with a focus on quality and income. We choose the highest quality assets our team can find because we think they're most resilient in time of stress, and we seek to generate a large proportion of our income in cash. At the end of 2017, our balance sheet is well diversified. Here on the left-hand side of the screen, you can see our asset mix by our various asset classes, and on the right-hand side of the screen, you can see our geographic diversification. We are developed markets investors historically. Michael referenced earlier the opening of our office in Singapore, and over the next couple of years, you can expect to see a tilt into emerging markets. Let's move to funded status. This is the statement that Marianne made at the very beginning of our meeting, that our funded ratio has improved for the 5th consecutive year. This is the smooth funded ratio. Those of you that have been to these meetings before will remember that we calculate our funded ratio on a smooth basis, which means that we take the appreciation in our assets and we average it out over 5 years to produce a nice smooth growth in our assets, and we compare that to our liabilities. And we do that because it gives a better picture over the long term. It smooths out some of the volatility that we see in markets. And as you can see, we've been improving since we hit a low in 2012 of 86%, and as Marianne mentioned, we're on our way towards full funding. I also get asked very often, well, how does that compare to the market value of the assets? So here's the fair value of our assets compared to our liabilities, and you can see that on a fair value basis, our financial position is even stronger. There's a $6 billion gap at the end of 2015. The fair value of our assets are $6 billion higher than the smooth value of the assets. And that $6 billion is available to us to absorb volatility that we might see in markets, to improve our funded status, or to help us reduce our discount rate further, which is something that Michael talked about earlier. Let me give you some indication of what a $6 billion difference means. It's about equal to a 15% loss in our public equity portfolio. So it's a comfortable margin, but in the grand scheme of things, it's not enormous. As our funded ratio has improved, so has our deficit reduced from $5.7 billion to $5.4 billion. Our liabilities increased by $7 billion last year. That includes $3 billion of new benefit accruals. I think that's tremendous. It means that our members are working. It means that they're accruing pension benefits into the future. And our liabilities at the end of 2017 stand now at $94 billion in pension liabilities. What are the main drivers in the improvement in our deficit? Well, $2 billion came from investment returns. $800 million came from contributions. As you know, our contributions are set a little bit higher than the minimum required by the law, and that is causing our funded ratio to improve. But we cut our discount rate in 2017, and that cost us $2.7 billion, and I'm going to spend a little bit of time on that. So as Michael referenced, our discount rate at the end of 2015 was 4.25% real and 2% for inflation. We took it down by 5 basis points at the end of 2016, and we've taken it down by 20 basis points at the end of 2017, and we're progressing nicely towards our target. Why a lower discount rate? We need a lower discount rate to improve the sustainability of the pension plan, to create some more financial resilience as we move into the future. Michael referenced that OMERS is approaching and is now in a period of plan maturity. In 2014, 8,000 members of the pension plan transitioned from active membership into retirement. In 2017, that was 10,200 members. So a 25% increase in just 3 years. By 2030, about 11,500 members will be retiring each year. That, ladies and gentlemen, is the impact of the boomers moving through the system and into retirement. And that's the impact on the pension plan of plan maturity. This was the year when pension payments and pension contributions were about equal. So, ladies and gentlemen, we are now a mature pension plan, and we need to deal with the consequences of that. You've seen this chart already. Michael spoke briefly to it in his remarks. I want to spend a little bit of time on this chart, talking a little bit about what plan maturity means. Here's the history. In 1977, 8 members were active in the pension plan for every 1 retiree. Today, 2 to 1. By 2030, 1 to 1. What does that mean? That means that the resilience of the pension plan to absorb shock is reducing, because our retired members have guaranteed benefits, and any loss needs to be spread over a smaller active workforce relative to the retirees. At the same time, life expectancy is increasing. According to Sun Life, human life expectancy in developed countries has improved by 3 months every year for the past 140 years. The sanitary revolution, the development of vaccination, the discovery of antibiotics, the improvements that we've made in cardiovascular health, and we are now on the cusp of gene therapy and even better cancer treatments. Congratulations, ladies and gentlemen, you're all becoming immortal, and that's great for everyone in this room. But it's a profound challenge to a defined benefit pension plan. And here's the OMERS data. Over the last 30 years, you see an increase in life expectancy for males of just under 5 years and just under 4 years for females. And that is increasing and moving into the future. At the same time, it's not just OMERS